89. That is the price silver hit on Tuesday morning. March 10th, $89.59 per ounce. A 7% surge that ripped through the overnight market, broke through resistance, and caught every short seller on the wrong side of the trade while the Western world slept. And every single headline this morning told you it was about Iran. They are wrong, not partially wrong, not missing nuance, not oversimplifying, wrong. Because what moved silver 7% on Tuesday was not a war in the Middle East. It was a number buried inside COMEX vault reports that the mainstream financial press has not reported. A number so dangerous that when you understand it, you will understand why silver surged and why it is not going to stop at 89. 384 million ounces of silver are currently promised on paper for May 2026 delivery. Contracts signed, obligations binding, 384.5 million ounces. There are 78 million ounces in the vaults. Not 384 million, not 200 million, not 100 million, 78.5 million. Let me say that again. 384 million promised, 78 million available. For every ounce of real deliverable silver in a COMEX vault right now, 4.9 ounces exist only on paper. And on the last first notice day, February 27th, 61% of all deliverable silver was demanded for physical delivery in one session. Not rolled over, not cash settled, demanded from the vaults, 61% in one day. And if you think a 4.9 to 1 ratio is routine, if you think 61% delivery demand is normal mechanics, if you think losing 86% of registered inventory in 60 days is business as usual, I need you to examine what is happening inside those vaults very carefully. Everything in this video comes from CME Group vault reports, CFTC filings, research from Citigroup, JPMorgan, Goldman Sachs, and Bank of America, Silver Institute supply data, and price records from MarketWatch, the Wall Street Journal, and Reuters. Not rumors, not speculation, documented, sourced, verifiable data you can check before this video ends. By the end, you will understand why silver moved 7% on Tuesday, why the May 2026 contract expiration could be the most dangerous date on the commodity calendar, and what 3 historical commodity crises reveal about whether this is the beginning of silver breaking 100 or the most dangerous trap of 2026. Because when paper promises exceed physical supply by this magnitude, the resolution follows a pattern I track called the paper fracture sequence. Either the paper market forces the physical market down, or the physical market shatters the paper market apart. There has never been a third option. 3 triggers converged on Tuesday. The mainstream gave you one. Trigger 1. February 28th, U.S. and Israeli forces struck Iran. Supreme Leader Ali Khamenei killed. His son-appointed successor. Iran threatened to close the Strait of Hormuz. 20% of global oil transits through that waterway daily. Brent crude hit 119.50 intraday. WTI broke 110. Analyst Homayoun Falakshari warned oil could reach 150 by end of March. Silver is now up 175% year over year. But oil spikes have moved silver like this before. In March 2022, oil broke 120 on the Russia-Ukraine invasion. Silver stayed between $24 and $26. Barely moved. Oil alone does not explain Tuesday. Trigger 2, COMEX registered, silver dropped below 78.5 million ounces. In September 2025, those vaults held 200 million ounces. 6 months later, 78 million, a 60% decline. On March 5th, alone 5.91 million ounces vanished in 24 hours. Goldman Sachs documented what they called extreme price sensitivity. Their finding: under current conditions, a weekly demand surge of 1,000 tons would move silver approximately 7%. On Tuesday, silver moved exactly 7%. But the vault drain has been gradual. It alone does not cause a single session explosion. Trigger 3, and this is the one nobody is connecting. The banks showed their hand. Citigroup's Maximilian Leighton raised his silver target to $150. His exact words: silver is behaving like gold on steroids. Bank of America's Michael Widmer published a range of $135 to $309. Deutsche Bank targeted 100. BNP Paribas Fortis predicted triple digits. When 4 of the largest banks on earth set targets up to $309 and silver trades at 89, institutional capital repositions at 5 in the morning when every order moves the market 3 times further than normal. But here's the part that should alarm you. These triggers did not add together, they multiplied. Fear times, scarcity times. Institutional permission equals violent overnight repricing. Now let me show you why 4.9 to 1 is a ticking clock. The paper fracture sequence operates in 4 stages. Stage 1. Promise accumulation, contracts stack up. Institutions sell silver they do not own. As long as nobody demands metal, the system functions. Stage 2, divergence. Physical supply tightens while paper obligations expand. Vaults drain, premiums emerge. Most people do not notice. Stage 3, the reckoning. Paper exceeds physical by a ratio the market cannot sustain. 61% demanded in one session. 86% drained in 60 days. This is where silver is right now. Stage 4, resolution. Real deficit means physical wins. Prices consolidate, then resume higher. Manufactured deficit means paper wins. Prices crash. That distinction is the most important variable in this video. 384 million paper ounces sit against 78 million physical. If 25% of May contract holders stand for delivery, they demand 96 million ounces. There are 78 million available. 96 is larger than 78. If 61% stand like February, the demand reaches 234 million ounces. 3 times more silver than exists in the vaults. You do not need a conspiracy theory, you need a calculator. This has played out 3 times before. Each time the outcome depended on one variable, real deficit or manufactured. Case 1, silver. 2009 to 2011, financial crisis, silver from 12.59 to 49.47, a 293% gain. CME raised margins 5 times in 2 weeks. Silver crashed from 49 to below 40 in 1 week. But the deficit was real. Quantitative easing was real. Zero rates were real. Silver never returned to $12. Verdict, real deficit. Intervention paused the rally, did not reverse it. Case 2, nickel. March 2022. London Metal Exchange, Jingshan holding short position exceeding 150,000 tons. Nickel surged from 25,000 to 101 on now 365 per ton, 270% in 72 hours. The LME halted trading for a week, canceled $3.9 billion in completed trades, retroactively. But here's the detail that matters more than any other. Nickel never returned to pre-squeeze levels, settled between 25,000 and 30,000, permanently higher. Because Russia's invasion created a genuine supply disruption that no rule change could fix. Verdict, real deficit. Most aggressive intervention in modern history, failed to reverse the trend. Case 3, silver, January 30th, 2026, 7 weeks ago. All-time high of 121.64, then a 31.4% crash in 1 day. The Wall Street Journal called it the worst day since 1980. What happened next should tell you everything. February 5th, bottomed at 73.42. March 2nd, recovered to 95.85. March 6th, corrected to 83. March 10th, surged to 89.59. Every crash gets bought. The March low of 79.50 is above the February low of 73.42. The floor is rising. The Silver Institute confirmed 2026 is the 6th consecutive year of structural deficit. 67 million ounces projected shortfall. 820 million cumulative deficit since 2021, equaling an entire year of global production, consumed from reserves. Verdict, real deficit. Multiple crashes, each floor higher. Pattern holding. 3 cases, 3 real deficits, same outcome every time. Interventions create corrections. Then, the deficit reasserts. So the binary question. Is silver's current deficit real or manufactured? Mine production. 820 million ounces per year, flat for 5 consecutive years. 75% mined as byproduct, meaning higher prices cannot incentivize new supply. New mines require 7 to 15 years. Industrial demand. 59% of all silver goes to industrial use. 650 million ounces annually. Solar panels, electric vehicles, semiconductors, 5G. These do not create artificial demand. They create structural, irreplaceable demand regardless of price. The deficit is real, confirmed for 6 consecutive years. Not fixable in any time frame that matters for May. Now the risks. Because ignoring the bear case makes me no different from channels that only tell you what you want to hear. Marko Kolanovic, former JPMorgan chief strategist. His words, meme traders attempting to take over the market. He predicts a crash to 50. JPMorgan's official year-end target is 85, below current price. Ross Norman of Metals Daily called this market a casino. They could be right temporarily. January was 31% down in 1 day. If Iran de-escalates, $5 to $15 of premium evaporates. DXY at 98.91 yields at 4.16%. Dollar strength creates headwinds. And if you are over-leveraged, none of it matters. Buyers at 121 on January 29th are down 26% right now. Being right about direction and wrong about position size produces the same result as being wrong about everything. But here's what the bears cannot explain. If this is a bubble, why did 61% of contract holders demand physical metal? Speculators do not demand delivery. They roll. They settle. 61% delivery demand is not speculation. It is accumulation. Bubbles do not drain vaults. Structural shortages drain vaults. 4 things to understand. First, Tuesday's surge is a symptom. The story is 384 million paper ounces against 78 million physical. That gap must close. It will not close gently. Second, watch May first notice day. If delivery demands approach 61%, the math breaks completely. Even at 25%, the math breaks. That date is the most important date this quarter. Third, expect more crashes. January 31%, February 11%, March 10%. The pattern is spike, crash, higher floor, spike again. Understand it, and the crashes become opportunities. Over-leverage and they destroy you. Fourth, the banks are split. Citigroup says 150. Bank of America says up to 309. JPMorgan warns of 50. When the largest institutions on earth disagree by that magnitude, someone is catastrophically wrong. May tells us who. Subscribe and turn on notifications. I'm tracking every vault movement and delivery demand between now and May. 384 million promised, 78 million available, 61% demanded last month, 86% drained in 60 days. 3 historical fractures all resolving the same way when the deficit was real. The paper broke, not the physical. Something has to give. When it gives, it will not be gradual. Comment below. Does May break the COMEX or do the banks kick the can? I read every single comment. Markets can stay irrational longer than you can stay solvent. But supply deficits are not irrational. They are math, and math always wins. See you in the next one.